Hey, what's up, everybody? It is Monday, July 11th. Euro crashing down, approaching parity to the dollar. Wow, man. I watched that and I just I'm in disbelief. I got to tell you, I'm in disbelief that the Europeans, they just blindly and willingly follow whatever Washington says, even if it means the destruction of their economy and their currency. I just wonder, as the euro continues to fall, and it will, it's going to continue to fall, I just wonder if some of that political cohesion is going to erode. I mean, the people cannot be happy about this with the energy situation, and now the currency unraveling. I mean, it's just incredible how the Europeans have just, been blindly following the orders of Washington to the complete destruction of their economy. I mean, look at Germany now, first time since 1991, running a current account deficit. Really, really unbelievable. But hey, we have the same stuff going on here. Biden's policies are, the majority of Americans are opposed to Biden's policies, but these policies remain in place, intact. Exporting of petroleum, the war, and supporting the war in Ukraine, sanctions, all these things bringing economic harm here domestically. But, and then he says, go out and vote. Well, we do vote, but nothing changes anyway. Incredible. I am short the euro, and I don't see any relief. You're going to get little relief rallies in the euro, but as long as these policies stay in place, and believe me, the situation is going to worsen once we get to the fall and then winter without that Russian gas and Russian energy coming in. I mean, prices are going to skyrocket. The euro area trade deficit is going to expand exponentially, and I just think that is a very negative development for the euro. And if the ECB tries to counter this by raising interest rates, that's just going to make it worse. So, I mean, I'm just sitting back, short, making money on this, but at the same time, I'm just shocked that the continuation of these policies, the obedience to Washington at the destruction of your economy, it's just it's amazing. But, humans could be like that. We can many times act against our self-interest out of pride, out of ego. There's all kinds of motivations behind it. Anyway, let's talk about the markets. We were down today. We had a positive flow on. Now, I've noticed something in the past few days, which is a departure from the pattern we saw in June. In June, as I was explaining to you during the course of the month, nearly every single day we had a fiscal drain. In other words, where taxes exceeded spending on that day. So we were having a fiscal liquidity drain every single day, with the exception of the days when we had a Social Security payment, and of course the first of the month when you get that big payment, 100 billion, 95 billion. This last one was like almost 120 billion. But so far in July, these days have been managing to squeak out a positive liquidity flow. So we had only one day of drain. That could have been last Wednesday or something like that, if I have that correctly, or last Tuesday possibly. But since then, we've managed to have a positive liquidity flow, a net positive liquidity flow. In other words, spending was exceeding tax deposits, and so that's positive. That's good. We have a 90.3 billion deficit for the month so far. That's good. But again, we still have not recovered the April tax drain. I've gone over the numbers. I mean, April we had a 324 billion surplus, so that was a net drain of 324 billion. And then we had what, an 86 billion deficit in May. Then we had a 54 billion deficit in June, so that was 140 billion. And now we have a 90 billion, so that's 230 billion deficit. But there's still a gap there. 324 billion minus 230 billion is what, 90 something billion. So we still need another 90 billion deficit just to recover where we were in April prior to the tax filings, all right? So it's trickling back in. And that's why I think we've seen the worst on the downside for the market. Of course, sentiment is really, really negative. If you look at the AAII weekly sentiment survey, I mean, some of these bullish numbers are so low. I mean, like, we haven't seen numbers like this in like 30 years. I mean, they're really, really low. The put-call ratio, which peaked out probably, I got to go back and look, but probably peaked out in May at the highest levels. It's starting to come back down. If you look at the put-call ratio, and I follow this pretty closely, you have to wait until you start to see turns in that ratio. I look at a 10-day average and a 20-day average of the put-call ratio. When those things start to turn around, that's a reflection of some shift in the expectation, shift in sentiment. So, like now, for example, it's coming off a peak. I look at that as a bullish development, okay, in the nascent early stages. What else? The bank data was good. Again, for the week ending June 29th, you got another increase in loans. Loans now rising at the fastest pace in 26 or 27 months. Those included commercial and industrial loans. It included real estate loans. It included consumer loans, both credit cards, revolving credit, and automobiles. So the loan data from the banking sector, to me, says that consumer activity and investment, like capital spending, that's still okay. So when we get to see second quarter GDP, all right, which is almost certainly going to be negative, which would classify us in a recession, technically in a recession. That's the definition that economists use. 2 quarters negative. That we'll have first quarter was negative. We're going to have second quarter negative. When we get to see that data for second quarter, which is going to be at the end of this month, that's the first preliminary estimate. I suspect the weakness is going to come from 2 areas. It'll come from net exports, of course, which is the trade deficit. I always tell you guys that's income that flows out to the foreign sector. And it'll come from a decline in government spending, both federal and state and local. Okay, I don't think it's going to come from consumption. Personal consumption, I think, is going to be decent based on bank credit, what I'm seeing in bank credit. And I don't think it's going to come from business investment because, again, we've seen like commercial and industrial loans, they're growing now at the fastest rate in 17 or 18 months. So they've had a really big turnaround, and that's a good sign. It means the business sector, not the household sector, but the business sector is still very active in terms of capital spending and investment. So is the household sector in terms of personal spending. Personal spending is the biggest component of GDP. Next is government spending, and then business investment. So I think where the negative is going to come in, it's going to come in on the trade deficit side, and it's going to come in on the government spending side. Government spending is, it has slowed down. Again, I've gone over the numbers almost every single video that I make. But the leading spending flow from the federal government is still running like $570 billion a month. that is significantly above the pre-pandemic monthly flows. I mean, the average pre-pandemic monthly flow was around 420 billion. You know, that was like when Trump was in office. It was absolutely enough to power a really, you know, bullish trend in the stock market. The problem now is not really a problem, but I mean, to characterize what's going on now is that we've dropped down from, you know, close to 700 billion a month last year, you know, or the high sixes last year, to under 575 billion. So the economy has adjusted to that, a slower pace of government spending, and the inflation situation. And the inflation situation really manifests in, or I guess it affects us through the trade deficit. That is how, you know, that income flies out, not into outer space, but into the foreign sector. So that pretty much wraps it up. I still, let me just mention too that this week we're going to start second quarter earnings. They'll be filtering in. Keep an eye on Thursday. Thursday we get JP Morgan and we get Morgan Stanley. On Friday we get Citigroup and Wells Fargo. On Monday, next Monday the 18th, we're going to get Bank of America, Goldman Sachs, the financial sector. It's going to be interesting because, first of all, I think earnings, you know, in the big picture are going to reflect the recessionary condition of the economy right now. So, I mean, I think the markets have already discounted the negative impact or the expectation of what earnings are going to be. But I'm particularly interested in looking at the financial sector because the interest rate hikes, you know, that is income to the financial sector. Remember, the Fed has to pay higher interest on reserves. That's just like free money to the financial sector. Too bad we don't get it, right? That's what sucks. So yeah, I'm looking forward to see what the earnings are going to look like in the banking sector. I still say that banks are among the most undervalued stocks out there right now. I mean, if you have money to invest, and if you're a medium to long term, if you have a medium to long term outlook, I would be accumulating bank stocks right now. All the big names: JP Morgan, Citi, Wells Fargo, Bank of America, Goldman Sachs, Morgan Stanley. You know, some of the regional banks, Capital One, US Bank Corp. There's a bunch of them now. I think they're going to do very, very well over a period of time. I mean, they're going to get rising interest income flows. Lending is strong, and it's going to increase as the Fed's quantitative tightening expands. I've been all over that. You know, that's just going to free up space on bank balance sheets for more loans. So looking pretty good for the banking sector. I would definitely be accumulating bank stocks right now. Somebody asked me about gold. I just want to say that in the most recent CFTC data, the same patterns, the same trends. We have heavy liquidation of gold by speculators. That includes large speculative funds, commodity funds, and small speculators. They're not net short, but they're close to being net short. In silver, actually, large speculative funds are net short. And we see that the commercials, which are gold producers and the dealers, the swap dealers, Wall Street banks, they've just been using the decline to consistently cover their short position, and that for them, that is like more and more an aggressive bullish posture. So again, if you got a longer term outlook for gold, if you're an investor with a medium to longer term, I mean, this is an extraordinary opportunity to be accumulating some gold positions, but you have to be patient. I think this speculative liquidation is going to continue for a while until, you know, we get a big net short position on part of the speculators. That's going to happen, in my opinion. So that's the update for today, folks. I sent out, it's Monday, so I sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, www.pitbulleconomics.com. Bye.